Welcome to the Checklist for Survival, a series of videos produced by John Stewart, president of QP Consulting Inc. This video is the second in the series and is titled Your Company's Chart of Accounts. For additional information about John Stewart or to view his first video on sales per employee, please visit the website at www.quickconsultant.com. Now let's hear from Stewart as he discusses the important role that a chart of accounts plays in managing your business.
Good morning, everybody. This morning we're going to be talking about chart of accounts. Now, for some of you out there are very familiar with your chart of accounts, what the chart of accounts means. For others, you still get that blank stare when you mention chart of accounts. A lot of people don't know what a chart of accounts is. We're going to be talking about that this morning, and I'm going to be stressing at least two important factors that you must have on your chart of accounts. A quick story. About 30 years ago, back in early 1980, I was asked to serve a vacancy on the board of directors of NAQP, and I was asked to be treasurer. I knew nothing about accounting. I knew nothing about chart of accounts, profitability. I was new to the industry like so many back in the early 1980s. I sat on the board, and the first thing that was brought up for action by the board was a final approval of the industry's chart of account. I sort of looked around, and everybody else seemed to be in agreement that it was a great chart of accounts. Of course, I didn't know what a chart of accounts was, but I wasn't going to vote against it. So I raised my hand along with everybody else, and we approved the industry chart of accounts. For the next 30 years, NAQP and now NAPL have been producing on a biennial basis what's called an operating ratio study, or now the name has been changed to the financial benchmarking study. This study is invaluable, and before the end of this presentation, I'm going to provide you some information as to where you can get this report. It contains dozens and dozens of profit and loss statements based on profit leaders, laggards. It compares franchises and independents. It compares companies with sales of $2 and $3 million. It compares sales of companies with $500,000. The critical thing about ratios is, actually there's two facts. One, when we mention the word ratios, we are talking about percentages of expenses as compared to annual sales. So if we have $500,000 in sales and we've got cost of goods of, let's say, $250,000, which would be extremely high, 50%. We're looking for a percentage out to the right-hand side. Next, and probably most important, is the fact that we stress that you must break out payroll expenses on your financial statements separate from all other expenses. Now that means that the standard chart of accounts that you see for many industries, we have a category called sales. And then beneath it we'll have cost of goods. And from industry to industry, company to company, what we have under cost of goods tends to vary quite a bit. And then we'll have an overhead expense. And under overhead expenses, you'll find all the typical advertising, marketing, utilities, rent, depreciation, et cetera, et cetera, et cetera. And most oftentimes, we'll see payroll scattered all throughout those financial statements, making it very difficult to analyze. Now, I will tell you now and a little bit later, payroll expenses are the single largest expense in this industry. And therefore, we need to break out payroll expenses under its own separate category. And I'm going to show you that in a minute. But first of all, let me just show you some of the kind of information that we have in the in this operating ratio study. Now, there's loads of graphs in here, and there's also a lot of charts that we're going to show you. But for right now, I want to show you the first chart. We'll zoom in on this, and we'll get a close-up view. But it's called the sources of income. It's how we break out sales in the industry. Now, we're not necessarily suggesting that you break out all these items, but as you'll see, we suggest and provide breakouts in our studies, in the benchmarking studies, of all these types of sales by categories. You'll notice that black and white copying is now 10% of sales. Color copying is 14%. It used to be 6 or 7% probably 6-7 years ago. Printing is 35%. We break out printing as opposed to in the past when we combined printing, pre-press, and bindery sales. But that's really not that important right now. What I do want to move to is my second slide. And my second slide then represents breakout of expenses. Okay, now we have our slide of breakdown of expenses. And this is where I really want to stress. We have almost every financial statement that I see breaks out cost of sales, okay? And we also break out overhead expenses. By the way, these percentages are the average percentages for the entire industry. Cost of sales happens to run about 29% across the industry. Overhead expenses average about 26.9, 27%, okay? The most important breakout, the most important ratio in running your company these days is payroll. You will notice it's running at approximately 33%, 32.9%, which says after paying all the expenses of a business, all these expenses, the average owner in this industry is left with about 10.7% in owner's compensation. Owner's compensation is simply defined as everything that's left over in the business after paying all the bills, but before paying the owner a salary, perks, and other benefits. 10.7%. Okay, now let me move on to a couple of other things in our chart of accounts. The benchmarking study provides breakouts of virtually anything that you can imagine. If you want to look at the profitability of the best and the worst firms in the $1 million range, you can find it in this study. If you want to look at companies doing $500,000, you can find comparisons there. If you want to compare companies with sales, outside sales individuals, as opposed to companies with no outside sales, you'll find those performances and those ratios in this book. Before the end of this presentation, you're going to see a slide which is going to allow you to get an 18% discount if you purchase this study from NAPL and you mention this video that you heard it from John Stewart. By the way, I don't get any kickbacks, I don't get any commissions or anything whatsoever. I just called NAPL and arranged for people watching this video to get an 18%. Okay, first of all, who's responsible for designing the chart of accounts? Meaning, who's responsible for saying what goes where? To be honest, it's not your accountant, it's not your lawyer, it's not your brother-in-law. You are responsible for deciding what goes where, with the one caveat. And the caveat is that your payroll expenses, all the payroll expenses, that's unemployment, workman's comp, health insurance, wages, salaries, benefits, everything needs to be drawn together under one category and of payroll expenses. Okay? So I've stressed that enough. Now let's move on to a couple things. A couple of words, editorial comments about accountants. Accountants don't know your industry. You do, or at least you should. Accountants generally don't know about a chart of accounts for this industry. They should, but most of them don't. If you want them to follow an industry chart of accounts, you're going to have to provide it to them and say, this is how I want my financial statements broken out. Accountants don't necessarily know the most expenses, the most typical ratios or expenses in this industry. You do, or you should. All that information can be found in the benchmarking study. And accountants, quite honestly, don't have access to studies like this unless you provide them. Quite honestly, if you want to make a copy of this and provide it to your accountant after you bought it, more power to you. Now, let me get back to one more slide that deals with the chart of accounts. And we're going to be looking at a slide that looks similar to this. And I think this is probably one of the most startling charts you're ever going to see in this industry. And I'm going to pull it up now. By the way, I am using an iPad, and I'm using a program as I erase this, and we'll probably show some of my fumbling around here. And I'm pulling this program up. And the interesting thing I want to tell you about this is I'm using a program called NoteTaker. NoteTaker was developed by a gentleman named Dan Bricklin. Now, unless you're 55 or older, you probably don't recognize Dan Bricklin. But Dan Bricklin is responsible or given credit, equal credit, with giving a true use for personal computers. He developed the first spreadsheet. It was called VisiCalc. Of course, all of you use Excel now. I use Excel. But in the very early days, back in the 1980s, we were using a program called VisiCalc. This is certainly a much improved program, and it now allows me to go from the iPad to a video capture card to a program to another program, and with some miracles involved, we get onto this. Now, I've already outlined a couple things on this, but we're going to look at profit and loss comparisons 1983 through 2009. Okay, 1983, we only had sales. The average sales in this entire industry were 336,000. 1995, it moved to 782,000. By 2009, which is the date, the period of time covered by this study, We are reporting average sales in this industry of slightly more than $1 million, $1,016,939. This is the most important thing that you're going to get out of this presentation, I hope, today. First of all, notice that we had cost of sales in 1983 of 29.7%. Let's move to 1995. Cost of sales, 29.5%. Hardly a difference. Actually, it dropped a little bit. What happened in 2009? Cost of sales, 29.5%. The critical problem in this industry is payroll expenses. 1983, it was 24.3%. 1995, 28.6%. By 2009, it's 32.9%. This is the primary, almost sole cause of the decline in profitability in this industry. It's payroll costs. And it's quite amazing when you consider that our industry has undergone dramatic changes in over 30 years. We've gotten more and more productive equipment, faster equipment, better equipment, equipment driven by digital technology, and yet instead of being able to reduce the number of people required to produce the product, we seem to be adding to that. And let me, one more editorial comment, by the way. It's interesting that the companies in this industry that do the best don't pay their employees less. That's not how we reduce payroll expenses. They actually pay more. They pay their employees more than companies in the bottom quartile. The difference is they have fewer employees. If you'll go visit my video on sales per employee, you will see more details on that. Okay, we're finished with this slide for right now. And I'm going to, and by the way, this slide, before I eliminate it, this slide is going to be available on my website to download and to print out for your information. But I will tell you much more information than what you've just seen on that slide is contained in this report. Okay, now that's it. That's actually it for the slides that I'm going to talk about. But what I do want to get into is I want to show you some typical, first of all, I want to show you, and we'll be providing close-ups of these charts later, but I want to show you that some of the typical types of statements and information available in this benchmarking study. And once again, we're talking about chart of accounts and key ratios, and this study is filled with them. This is the first page. It's an all firms summary. It compares all firms, all independents, and franchises. And you'll notice it's following the format that I've just talked about. We break out sales here. We break out cost of goods in this area. In fact, I may just highlight these now, and then this will show on the video. Sales, how we break out sales is probably not that important, but we have cost of goods and the various items, paper, copier service costs, materials, outside services, brokered services, etc. Most important of all is this payroll cost. You must be breaking out payroll costs separate from all other expenses, and then we show overhead expenses, and then down at the bottom, we show average profitability. This benchmarking study is filled with these types of reports. Here's all firms by profitability. The top quartile, which is the 75th to 100% quartile, and the bottom quartile. Forget the two guys in the middle. Well, we can look at statements like this, and we can see the differences between the winners and the losers. Bottom quartile companies are averaging $1,016,000, and their profitability minus 1.76%. That means they're losing almost $2 on every 100 that they take in. The top quartile, $906,000 average sales, and they're showing an average profitability or owner's compensation of 25.17%. This book is filled with information, and I can't imagine running a business without having the benchmarking study. Here's another one, all firms by profitability, another report, and we've got many others. There's also balance sheets in the study. Now let me show you from my experience. I've been doing consulting for 25, 30 years. I put presentations on seminars, and recently in the past 2 years, I've been doing an extensive number of evaluations for companies. And this is a good example, and we'll have maybe a couple of close-up shots of this. But under cost of goods, exactly what I was pointing out before. He's got labor, payroll costs, insurance, health care costs, broken out all over this financial statement. Now, I will say he does have his percentages or his ratios on the side. Happens to be a 2-page statement. Here's some more payroll costs. Problem is, he does show the ratios. The other problem, though, is he can't tell me what his payroll expenses are, and I'll bet if I ask this company, He wouldn't know it. And if I did tell him, he'd be shocked. Now let's take a look at another set of financials provided by one of my clients, and I was doing a valuation for him. This was his financial statements. Now, once again, he's got payroll, labor costs, he's got direct labor, contract labor, production wages, contract labor down here, outside insurance, health insurance, workman's comp. He's got these expenses all over the place. What's missing? No ratios whatsoever on his financial statements. This is a gentleman who can't really tell me what his expenses for total payroll costs are. Here's another set of financial statements I received. Of course, I've taken all the company names off, but in this case, under cost of goods, he's got payroll. And then on the second page, he's got more payroll expenses. Now, he does have his ratios, but in order for him to determine what his total payroll costs are, which is, I've mentioned a couple of times, the biggest expense in running this industry, he has to, if he wants to, if he's interested or needs to, he needs to extract all these different percentages and add them up. Well, he shouldn't be doing that. His chart of accounts, his program, whatever he's using for his accounting program, ought to be pulling that information together. When I do an analysis and when I do a valuation of a company, I end up recasting all the financial information. I take the information that's provided to me and I extract it and then I reorganize it. So here's a company that I did a valuation for, and we had year 2008 and then 8 months, and then we had a projection, etc. But one of the interesting things was I had to recast his financial statements, and I'll highlight this, and this will show up when we pull a close-up on it. His cost of sales, okay, he had his cost of sales, and we're projected out here, and you'll see the highlights of this here. But the thing that after I extracted all the payroll expenses under a separate category, which was bindery labor, pre-press labor, office salaries, commissions, contract labor, payroll tax expenses, etc., 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 it turns out this gentleman has a payroll expense of 41.4%. Ladies and gentlemen, you can't survive in this industry with payroll costs that high. You simply can't. You can lower your general overhead expenses in some cases and make adjustments there. You're not going to make any adjustments in cost of goods, no appreciable differences. The only thing that you can really control in terms of profitability in this industry, you can move into a smaller place, you can reduce rent, but most of the expenses under general overhead expenses are, by their very nature, fixed expenses. Cost of goods are variable expenses. They go up and down with sales generally. Payroll is neither a fixed nor a variable expense, and that, however, the variable part needs to be controlled by you, the owner. I want to stress as best as I can that this financial report, this benchmarking study that NAPL produces, is one of the most valuable documents. I couldn't imagine a company in this industry, certainly in 2011 or 2012, operating their business without having access to the information. The executive summary in this report, not written by me. I do the rest of this report. I gather the information and publish it. But the executive summary by Larry Hunt is worth its weight in gold. You read Larry Hunt's executive summary, and you're going to understand this industry better in 15 minutes of reading than 90% of the industry. So with that, I'm going to close this presentation and suggest that you strongly consider purchasing this report. I believe the price is $95 retail from NAPL, but they are offering an 18% discount, and you're going to see a slide at the very end of this presentation that will give you the name and phone number to contact. So with that, I hope you've learned something about the financial ratios and operating ratios in this industry and the chart of accounts. And if your chart of accounts doesn't match what we've talked about, then I'd strongly suggest that you consider revising it so that you can gather your information and better compare it to the industry at large. With that, thank you very much for listening. I appreciate it. Thank you.